Unit 4, Tax Impacts in Mortgage Lending. Introduction and Objectives. Lesson 1, Primary Residence Income Tax Deductions. Lesson 2, Installment Sales. Lesson 3, All About 1031 Tax-Deferred Exchanges. Lesson 4, Mortgage Fraud. Mortgage fraud, common schemes and red flags. Common schemes. Property flipping. It is illegal when a home is bought, appraised for more than its true value, and sold within a short time frame. Kickbacks to the parties are commonplace. Inflated appraisals. An appraiser intentionally submits a misleading report to a lender that indicates an inflated property value. Silent second. A property buyer accepts a second mortgage without disclosing it to the original lender. Often used when a buyer can't afford the down payment on a home. Nominee loans/straw buyers, concealing a buyer's identity by using another person's name and credit information to obtain a loan. Equity skimming. An investor receives title to a property, often by using a straw buyer, doesn't make the mortgage payments, and usually rents out the home until foreclosure occurs. False identity. Borrowers may use a stolen or fictitious identity to obtain a home loan. Undisclosed buyer rebate. The seller or another party provides funds that aren't included in the settlement statement. In order to be legal, rebates must be disclosed to the lender and must appear on the settlement statement. Red flags. Large adjustments to sales price without supporting comparable data, or a request that the list price be changed to reflect appraised value. The buyer requests a particular appraiser. The seller contributions include large decor or improvement allowances. The mortgage broker refers a pre-qualified buyer to an agent. It's suspected that the buyer doesn't intend to live on the property. The buyer's credit history is limited and provided by companies that either charge high interest rates, or the buyer's loan payoff history doesn't include interest payments. The stated income is unrealistic. Drastic increase in income from a recent raise or new job. Missing or inconsistent information on purchase and sales agreement. All About 1031 Tax-Deferred Exchanges. Under Section 1031 of the Internal Revenue Code, the owner of real property can sell that property and then reinvest the proceeds in a like-kind property to defer paying capital gains taxes. To qualify as like-kind, the exchange must be done according to the tax code rules. It does not mean you have to replace an apartment building with an apartment building, etc. Investors can reap significant tax benefits by taking advantage of the 1031 exchange, and in some areas, it's considered one of the best-kept secrets in the Internal Revenue Code. A properly structured exchange can provide investors with the opportunity to defer all of their capital gains taxes. This results in an essentially interest-free, no-term loan from the government. Instead of paying the taxes now, the investor can put those dollars to work on other investment properties. To qualify, the property must be held for investment or business purposes. Sale proceeds must be passed through the hands of a qualified intermediary and must not be received directly by the investor, or they will become taxable. All proceeds must be reinvested. Any cash proceeds retained will be taxable. The replacement property must involve an equal or greater level of debt than the relinquished property. If not, the investor will have to either pay taxes on the difference or put in additional cash funds to offset the lower level of debt in the replacement property. All timelines must be met: property identification within 45 days, closing within 180 days from the closing date on the relinquished property. Foreign investors may also participate in the 1031 tax exchange and are subject to the same rules of qualification. An investor can't defer capital gains taxes on a warehouse by purchasing a family home in which the investor intends to live. Nor does most personal property qualify for the 1031 exchange, even if it's used for business purposes. Investors can exchange property that's residential, commercial, industrial, or even leased, if the lease is for 30 years or more and includes ownership interest. Investors can exchange into vacant land, hotels, motels, etc., provided the exchange meets certain IRS rules. Parsing the IRS rules. First, there's the like-kind rule, which we've already discussed. Second, the basis of the original property carries over to the new property. It doesn't change. So if your investor has a property worth $500,000 with a basis of $100,000, and then exchanges it for a property also worth $500,000, the basis in the new property is $100,000 plus any new debt taken on and any cash paid out. Rule number 3. Rule number 3 is that the new property has to come with the same or greater debt load for the investor. If it doesn't, the investor will be liable for gains on the difference. The IRS doesn't want the investor pocketing any change on gains realized. This is simply a way to defer gains from one property by investing those gains in another. To be clear, any cash your investor receives from the proceeds of the sale is taxable. It's called BOOT. It doesn't mean there can't be a tax-deferred exchange, but the taxes on the BOOT are due and payable. Rule number 4. Rule number 4 is that the investor has to use a qualified intermediary to conduct the exchange. What makes an intermediary qualified, according to the IRS? Simple, he or she is not unqualified. In case that's clear as mud, your clients can't do the exchange for themselves. And if they've worked with the investor in the past 2 years, neither can the investor's attorney, CPA, or you, the real estate broker. You're not qualified. Joe Blow, unlicensed and uncredentialed, who doesn't know your client from Miley Cyrus, is qualified. So Joe Blow, whoever he is called a QI, or qualified intermediary. The QI will coordinate the exchange between the parties and their attorneys or agents, coordinate documents and money transfer through escrow, and submit a 1099 to the taxpayer and the IRS for proceeds paid. Rule number 5. Rule number 5, and it's a biggie, is that the investor has only 45 days from the day of closing on one property to identify and commit in writing to the next property. The investor has 180 days from the date of sale of property number 1 to close on property number 2. These are firm dates, and there is only one way to extend those dates. The President of the United States has to declare a natural disaster area that affects the properties or parties involved. No foolin'. This time frame can get hairy if you're in the middle of negotiations and the clock is ticking. Your investor client has a lot more to lose than the seller of property number 2 at this point, so keep these deadlines in mind and identify early, negotiate expediently, and sew up the deal before you run into trouble. Rule number 6. Disclosure of the exchange is rule number 6. The 1031 must be disclosed to the buyer. At the time of the sale and at the time of the purchase, you have to tell the parties to the transactions that you're doing a like-kind exchange. If your client changes her mind about the property in the middle of the exchange, her tax deferral may be in jeopardy due to the deadlines involved. If the change of heart occurs during the 45-day identification period, and by the way, the 45 days includes Saturdays, Sundays, and your birthday, so don't even think about any grace period until the next business day. It's 45 calendar days, period. If it happens during these 45 days, and your client hasn't yet closed on the sale of the property being sold, ask for an extension from the other party. Hopefully, though, you've identified a backup property, just in case. If so, extricate yourself from the first transaction and quickly get the other in writing within that 45-day window. This formal identification has to be made with the QI through fax, mail, or courier. The investor must do this in writing during that 45 calendar day identification period. Once the 45 days is up, that's it. Revoking and submitting a new property for exchange will not reset the deadline. So unless you think you can get the POTUS to write you a note for the teacher, forget about it. And if you get a slippery QI who suggests changing or backdating the paperwork, fire him on the spot. This is called criminal income tax fraud, and even the president can't write you a note for that. Let's say you fail to identify a property in 45 days, or the deal falls apart and you can't cobble another one together within that 45 days. What happens? It's not the end of the world, but it is the end of your investor's chance to do a 1031 for that deal. Game over, pay your capital gains tax. The 180 days is also firm unless the deadline becomes shorter. The rule is that you have to complete the 1031 exchange by the earlier of either midnight of the 180th calendar day following the close of property number 1 or the due date of your client's federal income tax return for the tax year in which the relinquished property was sold, including any extensions. This only becomes a problem if property number 1 is sold between October 17th and December 31st of any given tax year, because that would mean that the 180th calendar day would fall after April 15th, tax day. Additional IRS rules. Just in case you think you were done with the rules, remember, we're talking about the IRS. There are 3 more rules you should be aware of related to the identification of the replacement property. 200% rule: multiple properties are okay, but may not exceed 200% of value of the relinquished property. 95% rule: multiple properties are okay, as long as they total at least 95% of the value of the relinquished property. 3 property rule: up to 3 properties are okay with no fair market value restrictions. First, let's talk about the 200% rule. Your client could decide to exchange into more than one property. That's perfectly permissible. Remember that the debt load has to be equal or more than the current debt load. There's also a cap. While your client can identify multiple properties to exchange into, the combined fair market value of the properties can't be more than 200% of the value of the relinquished property. So if your client has a property worth $100,000 and can find 18 properties to exchange into, that's fine, as long as those properties' total value isn't more than $200,000. Then there's the 95% rule, which says that your clients can identify a bunch of properties with no regard to their value if the exchange they're moving into has a total value of at least 95% of the value of the property they're selling. So if your client has a property worth $1 million and identifies 6 properties with a total value of $950,000 or more, you're good to go. Because both of these rules can be a bit confusing, most people go by the 3 property rule. That's the last of the property identification rules from our friends at the IRS. The 3 property rule says that your investors can identify up to 3 replacement properties and, in this situation, fair market value doesn't matter, provided they meet the debt load requirement we've already discussed. For simplicity's sake, you can think of these as just 2 rules. As long as you meet the debt requirement, you can exchange up to 3 properties at any value. If you exchange more than 3, they have to have a value of 95 to 200% of the relinquished property. If your client finds and closes on an investment property and then decides to sell another property or before selling the original property, he can do a tax deferral backward. This is called a reverse exchange. You're still strapped to the 45 and 180-day deadlines, though, and it can get hairy. Installment sales. There are times when a seller will offer financing to the buyer, often because the buyer can't qualify for traditional financing, but sometimes because the seller would prefer to receive the proceeds from the sale over time rather than in one lump sum. The seller retains the deed until the amount is paid in full, which is the seller's assurance that the buyer will pay, because if not, the seller retains ownership and can evict the would-be buyer from the premises. Paying the seller over time. The buyer will contract to pay the seller the purchase price over time in a series of installments. As these installments are paid, the buyer begins to pay off the property. Once the buyer has paid the contract in full, the seller turns over the deed to the buyer. This type of sale is called an installment sales contract or an installment land contract. The terms are used interchangeably. During this process, the seller retains legal title of the property, ownership interest that is enforceable by law, while the buyer is said to have equitable title rights, financial or equitable interest in the property. Sellers will traditionally prefer an installment sales contract when they wish to avoid paying federal capital gains tax all at once. An installment contract allows the seller to recognize the gain over a period of years, as payments are received. Disadvantages. One strong disadvantage to this type of arrangement for the buyer is that the buyer doesn't have ownership in the property until it's completely paid off. With a traditional mortgage, if a buyer can no longer make payments, the buyer can usually sell it for a profit, or at least a return of the equity. Not so with an installment sales contract. Instead, the seller may receive many thousands of dollars, even hundreds of thousands of dollars, from a buyer, and, if the buyer becomes unable to make payments, the seller can keep all of the proceeds received up until that point and repossess the property. Deductions taken during home ownership. Tax deductions arising from home ownership extend beyond the closing table and into the ownership of the property. The Tax Cuts and Jobs Act of 2017, TCJA, implemented changes for mortgage interest deductions for those who are eligible for these deductions on their income tax returns.